Hi students, welcome to Commerce Solutions. So, as you know, our accounting series is going on. In this video, we will discuss accounting principles. Okay, different accounting principles. Let's start. Accounting is the language of business, and the principles of accounting are the grammar of the accounting language. So you know that how important is grammar to learn a language. So grammar is the basis on which a language will build in our mind. So it is very important to understand and learn the principles of accounting before preparing and maintaining accounting records and preparation of uh, financial statements and informations. Okay, so let's start and come to our PDF. There we will study and learn in detail. Accounting principle, basic concept and conventions. So under accounting principle, there are some concept and convention, basic assumptions. These are the principles of accounting. Some concept are principle, also some conventions are principles. So what is principles? So principles means rules. Okay. So let's read. Accounting is the language of business and generally accepted accounting principle. GAAP are the grammar. Okay, accounting is the language and principles of accounting, that is called generally accepted accounting principle GAAP. GAPs are the grammars. Accounting principles are the rules adopted for the recording, preparations, and presentations of financial statement at a particular time. So these are the rules we have to consider while recording the transactions and preparation of financial statement and presentation to the users of accounts. Due to gaps, financial statements are uniform universally and it leads to comparability and decisions making. So, why we should follow the principles of accounting? Why we should follow the principles of accounting? To attain the uniformity in the financial statement, we have to follow the rules of accounting, the principles of accounting. So why we need uniformity in our statement? Because uniformity leads to comparison. If our financial statements are not uniform, not prepared uh, under equal assumptions or equal concept, that will not be comparable. If a statement is not comparable to the similar company, or the statement is not comparable with our past year performance, then the user of accounting, or the stakeholders, they cannot take their decisions because the statements will be useless or meaningless for them if they cannot evaluate, they cannot compare the financial statement. So, to ensure the comparability, we need uniform financial statements. How the financial statements will be uniform, universally? How? When we will follow the gap, when we will follow the general accepted accounting principle, then automatically the financial statements will be equal, will look uniform worldwide. Okay, the gap is prepared by ICAI. Okay, the gap is prepared by ICAI, and ICAI follow the IFRS. IFRS means International Financial Reporting Standards. So our financial statements should be universal in nature, and all the users of accounts around the world, they can compare and take their decisions according to our financial statement. That's why we have to follow the rules prescribed by GAAP. Accounting principles are derived from experience and practice. Okay, the principles are man-made and it is derived from experience and practice. That means these principles are not like scientific principles or universal principles like the principles of physics, chemistry, for example, law of motion. Law of motion is universal in nature. It is very scientific because we can do experiment and we can prove that. But principle of accounting, principle of accounting are man-made and it is based on social science and it is developed from the years of experience and practice of accounting professions. So these are the man-made principles. These are not made by nature and uh, these are this cannot be experiment on lab and cannot be proved in lab. So practice usually depends on following three criteria. So practice of accounting depends upon the three criteria, that is relevance, objectivity, feasibility. Okay. We have to ensure these three qualities while practicing accounting. Okay, so what is first quality is relevance. Relevance means meaningful and useful for the users of accounts. Our statement of accounts, our financial information should be meaningful and useful for the users. That is got relevance. Objectivity. Second, objectivity. Objectivity means not influenced by personal judgment. Our statement, our recording should not be influenced by personal value or personal belief by the accountant. It must follow the neutrality, it must follow the principles, and also reliable or correctness and verifiable. Okay, reliable means there must not any material error and personal bias, and verifiable means our statement can be verified by another party, another auditor, or another verifier. Third quality is feasibility. Feasibility means possibility. Possibility means practically possible. Practically possible or not. Practically possible without undue complexity and cost. So the accounting system, the accounting records, accounting procedure method should be practically possible. Practically possible in the sense of if this is more complex, if the methods is very lengthy, clumsy, we cannot apply into our professions. Another thing is practically possible in the sense of cost. If it is cost very most costly to maintain these principles, so these are the costly. Due to cost, this cannot be possible. So when we shall maintain these three quality, when we shall maintain these three quality, if we will follow the gap generally accepted accounting principle, we can attain these three qualities in our profession, and if we attain these three qualities, our financial statement will uniform with others financial statement, and if our financial statement is uniform with others financial statement, then the users around the world, they can compare, they can evaluate, they can take their financial economic decisions with our organizations. That's why we have to follow the principle strictly while recording our transaction, while preparation of financial statement, and maintaining the financial informations, and this is most important thing, and this is the pillar on which the accounting profession is based. Okay, so then comes to classifications of accounting principles. Okay, we can classify accounting principle in the following manners. First classification is accounting concept. Okay, second is accounting conventions. Third is fundamental accounting assumptions prescribed by the accounting standard 1. So we can classify the whole principles into three categories. First is accounting concept. So accounting concept are the basic assumptions. So these are nothing but basic assumptions and principles on the basis of which transactions are recorded and financial statement are prepared. So these things are assumptions. What are the concepts? For example, accounting entity concept, money measurement concept, dual aspect concept, cost concept, verifiable objective evidence concept, going concern concept, accounting period concept or periodicity, realization concept or revenue recognitions, matching concept or expenses recognitions, accrual concept. So these are the 8 concepts under accounting concept. So next category is accounting conventions. So there are statements of practice or principles which are followed as accepted method or procedure by the enterprise over a period of time. The following are the accounting conventions. So full disclosure is a convention, materiality is a convention, and consistency is a convention, and conservatism or prudence is a convention. Conventions means statement of practice or principles. Okay, statement of practice means this is a traditions. Okay, traditions enterprise over a period of time they are maintaining like this. So this is a tradition. Here is a note. So conventions means statement of practice and concept means assumptions. So what is the difference between concept and convention? So the distinction between accounting concept and convention is more of academic interest than practice. So academicians are shows interest to distinguish these two terms, but in practice we are not distinguish this term because these all are principles. Conventions are based on experience and they are statement of practice. And concept, they are simply basic assumptions on which accounting profession is based. So no need to distinguish the accounting concept and convention because these are more over similar things. A third category is fundamental accounting assumptions. These assumptions are fundamental in nature and every organization should follow these three assumptions. It is a mandatory. If some organizations are not following these assumptions, they have to mention they are answerable. Okay, they are answerable. Let's read out. Accounting according to AS1 or Accounting Standard 1 issued by the ICAI, the following are the fundamental accounting assumptions. Okay, these three are fundamental accounting assumptions: going concern, consistency, and accrual. These three assumptions every organization should maintain while preparing, while recording their transactions. If they are not recording, they need to mentioned in note to accounts. The disclosure as a note is necessary If these assumptions have not been followed, so this is a compulsory things. So accounting principles may be a concept, may be a conventions, and may be a fundamental accounting assumption. Concept means basic assumptions. Conventions are come from the practice, that is a tradition or custom. And fundamental accounting assumptions are general things, very general things every organization should follow. So this, if we sum all together, this will result to accounting principles. So let's discuss all the principles one after one. First principle is accounting entity concept or business entity concept. As per this concept, an enterprise is treated separate from its owners and other person associated with it. All transactions are recorded from the point of the accounting entity and not from the point of owners. If this concept not followed, the financial statement will not give the true and fair view of the financial positions, as owner's personal transaction will be mixed with business transactions. This concept is applicable to all the form of the organizations like sole proprietorship, partnership, limited liability partnership, and joint stock company. So business entity concept explaining that the business and its owners are two separate entities. Okay. The transaction should be maintained on the viewpoint of business, not on the viewpoint of owners. Okay. So why it is so? Because it is a assumption, though it is a concept, this is a basic assumption. Okay. So if we are not taking these assumptions, the personal transaction of owners will mixed with the business transaction and it will not lead to true and fair view of the business organization's financial statement. Okay. So for the recording purpose, for the reporting purpose, separate we have to separate the accounts of owners and maintain it separately and distinguish it from the business account and business transactions. So let's take examples and take a practical examples and try to understand. So here is the example. Mr. X started business investing 7 lakh with which he purchased machinery 5 lakh and maintained the balance in hand. The financial positions of the will be as follows. The financial position will be as follows. So business started with cash, that is cash comes to business and we have to return to owners 7 lakh. Okay, we have to return owner 7 lakh. Here, capital is 7 lakh. We have purchased 5 lakh machinery. We have purchased a machinery worth 5 lakh. From where? From the 7 lakh cash. From 7 lakh cash we received as a capital. Okay. So 5 lakh is the machinery and the remaining portion is cash, that is 2 lakh. that is 5 plus 2, 5 plus 2 is equal to 7 lakh. Okay, so this is the account of owners. Capital means it is the claim of owners towards the business. Business received business received some money from owners and started business while investing on machinery 5 lakh, and this is the cash balance. We are showing it differently, that is, these things are our asset, these things owned by business, these things owned by business, and these things we have to repay to our owner. We have to repay to our owner, and this is a liability of business, and these two are asset of business. Okay, so let's take another example. This means that the enterprise owes to Mr. X rupees 7 lakh. Now, if Mr. X spends 5,000 to meet his family expenses from the business fund, then it should not be taken as business expenses and would be charged to his capital account. His investment would be reduced by 5,000. Following the entity concept, the revised financial positions will be. So here the question is telling that Mr. X draw 5,000 for his family expenses from the business cash, from the business fund, from the this 2 lakh cash. Mr. X draw 5,000. So it is the personal expenses. We should not enter these personal expenses. We should not mix these personal expenses with the business expenses. We have to segregate it. How to segregate? We simply deduct 5,000 from the 7 lakh capital, that is the liability of business, and we reduced the claim of owners to 6,95,000. So this is how we are separating the personal transactions of owner and showing in balance sheet as liability. Okay, before business has the obligation to pay 7 lakh to the owner. Now owner expend 5,000 from the business and we have reduced it 5,000. Now business have the obligation to pay 6,95,000. Okay, now the machinery is 5,000 and cash reduced from 2 lakh to 1,95,000. This is how we are maintaining our books of accounts by applying the accounting entity concept by separating the owner's transactions from the business transactions. Okay, if we were maintaining accounts as per the entity concept, this will reflect the true and fair view of financial positions of business. Otherwise, it will be mixed and it will lead to misleading the other user of accounts. Next concept is money measurement concept. Money measurement concept means we are taking the unit of measure, a common unit of measure, and that measure is money. Money means a currency of a particular state or particular nations. Okay, so currency in India, the currency is rupee. So we are measuring in terms of rupees. All the things we are measuring in terms of rupees. Though there are many physical unit of measure like kg, meter, square foot, pieces. There are many unit of measure. and we need a common unit of measure, and there is only one common unit of measure, that is a money in India, rupees, and in USA, that is a dollar. Okay, so let's read out. According to money measurement principles, only those transactions which can be measured in terms of money are recorded in books of accounts. Only those transactions which can be measured in terms of money, these transactions are qualified to recorded in books of accounts. Money as a common measuring unit helps to quantify in terms of money various type of data for determinations of profit and loss and financial positions. So there are many unit of measure, like pieces, a unit of measure. Suppose you have 50 number of computers. 50 pieces is the unit of measure. Suppose you have 1000 kg of raw material. Here kg is a unit of measure. These are the physical unit of measure, and there are diversify in nature. There are diversity in nature. So we have to maintain a common unit of measure so that we can present our transactions, we can add them, and we can present easily. So let's take an example and understand. If a business entity owns land 500 square meter, three buildings means three pieces of building, two cars means numbers of car, 50 computer means 50 pieces of computer, 1000 kg means 1000 kg goods, and cash rupees 1 lakh. So, can you determine the total asset? Can you determine the total asset with the help of this diversified unit of measure? How to total? Land 500 square meter, and three building means three numbers of building. Here numbers or piece is the unit of measure. Can you add 500 square meter plus 3 plus 2 plus 1000 kg plus 1000 1 lakh rupees? It is not practically possible. Since the above assets are in physical units, we cannot determine total asset by adding all the physical units. Here we need a common measurement, that is rupees. Rupees in India, dollar in USA. That is money. So we have to measure the monetary value of land. Okay, what is the monetary value of land? Monetary value of land is 20 lakh. What is the monetary value of three building? Three building monetary value is 50 lakh. What is the monetary value of two cars? Two cars monetary value is 10 lakh. That means each car 5 lakh. 50 computers, 50 computers monetary value is 10 lakh. 1000 kg goods, 1000 kg goods monetary value is 10 lakh. And cash is 1 lakh, and cash is money, that's why it is 1 lakh. If you add them, you will find the total asset, that is rupees 101 lakh. Okay, so if we will not measure in terms of money, we cannot record our transaction, we cannot maintain our financial information. That's why we have to measure in terms of money all the transactions. Those are possible to measure in terms of money. We have to do that, because if we are not doing so, we cannot present our financial data to the user of accounting. Okay, this is called money measurement concept. Okay, we have to record those transactions which can be measured in terms of money, and money as a common measuring unit, we have to consider, we have to measure all the assets, all the expenses into monetary form, and then we have to record. So this is all about money measurement concept, and there are two limitations or drawback of money measurement concept. The first one is all transactions and events cannot be expressed in terms of money. All transactions and events cannot be expressed in terms of money. For example, the managing director health is not well. Okay, managerial directors, their health is not well due to corona. So this is a very important thing. This is a very important event. If they will be sick, who will manage the business? Business can be wind up. So this is a very important thing, but we cannot measure in terms of money. So though we cannot measure in terms of money, we cannot record it financial reports. That's why it is a drawback. Okay. Another drawback is money is not a stable unit of measure. So money is not stable. Why money is not stable? Because the value of money is increasing and decreasing with the general price level changes in the market. When price are increasing, general price are increasing in the market, that is a case of inflation. In that stage, the value of money is decreasing, the purchasing power of persons, consumers, and different peoples, their purchasing power is reducing. So, in that situation, the value of money is reducing and it is not stable or constant. When the general level of price are decreasing, that is the case of deflation. In the case of deflation, the purchasing power of peoples are increasing and the value of money is increasing. And in this situation, money is not stable, not constant. Though the money is not stable always, it is a drawback. How? For example, we had purchased a building before 5 years worth 50 lakhs or 50 lakhs. Now, in current year, that land is worth double, like 1 crore. But we are showing in financial statement 50 lakhs. Now, the value of money is increased or decreased. Now, our asset value is increased, but we are showing in 50 lakh. Why it is so? Because the money value is not stable, it is not constant. Before 5 years it was 50 lakh, now it is worth to 100 lakhs. Okay, in this way the money is not stable. So these two are main drawbacks. Okay, these two are main drawback. Another point is there. In spite of above limitations, it is used as unit of measurement as there is no other generally acceptable unit. There are two major drawback, but we are using money measurement concept. Why? Because we have no option. There is no another common measure of unit like money measurement unit. So that's why we are following that particular principles. Okay. So for today, we'll discuss this much because the video already crossed 30 minutes. If we continue, it will be lengthier and it will divert your concentration. So, we'll stop here and please like, share, subscribe our channel if these videos are helpful for you and keep watching our videos. Okay, thank you all very much.